And Mr. M.S. Unnikrishnan, MD of Thermax, joins us on the show right now from Pune to talk one about the recent order that they have won, but also about the trends per se. Mr. Unnikrishnan, thanks so much for joining in. I would want to come back to where we left off the conversation when the IP data came out as well. But let's just start off with something that is contrary to what happened then, and that's an order win that you've had. It's gotten the stock excited as well. But just a brief on the 500 crore order that you just bagged.
Well, this is an order from a public sector undertaking for their greenfield expansion in the steel sector for a 2.5 million tons per annum capacity steel plant. There are two boilers which are going to be operating on the waste heat generated from the steel mill, the blast furnace, and they will convert that into 80 megawatt of electricity, and the entire scope of design, engineering, conceptualizing, manufacturing, constructing and commissioning of this plant. We won it against very tough competition, including from an international company which came from China. So this is a contract, and we've got a 24-month period to execute this, and we're very confident of doing it on time within the schedule.
Mr. Unnikrishnan, what is your current order book as of date, and how have order inflows been in the current quarter generally?
Well, we have seen a normal flow of orders for the standard products for the company in the boiler side, the chiller side, the water treatment side. However, we have not seen any substantial order inflow rather than this windfall order, which has come in the project side, which are of the larger ticket size. Which indirectly indicates that it is not something to do with the turnaround in the Indian capital goods industry that Thermax is showing an order book. I would take it as one of those orders which was in the pipeline, in discussion, in negotiation for a period of 6 months.
Mr. Unnikrishnan, the last time that we spoke, you did mention, and which was again, I'm referring to the discussion that we had when I think the IP numbers came out. And you had mentioned that it will probably be the next 12 to 18 months before normalcy returns in terms of order inflows. And also mentioned that this was probably a windfall order of sorts. Am I to assume that you're sticking to that estimate, that it is at least 12 months before any kind of meaningful order inflow to cap goods space returns?
I still maintain my comment on that, because on the ground level, post the new finance minister's announcements of policy corrections and some amount of impetus, we have seen some activity happening on the ground level in terms of people calling companies for negotiations, discussions. But the ground level order finalizations at a frenzied pace is not happening. I'm seeing activity happening on the food industry, food processing industry, isolated in textile industry, chemicals. But the real large chunky projects which are in the steel, cement, the power and oil and gas is yet to be starting. But I have hopes that things won't deteriorate any further, is my current understanding.
The other bit, Mr. Unnikrishnan, would be specifically if you believe that things could start materializing from two spaces. One, as you mentioned, cement. And the view that people have is that with the election year coming in 2014, things could really perk up in 2013. One, is that justified? And two, with the movement that we're seeing in the power space, which could probably form the large backbone for order book for you, could that happen in the first 6 months of the next calendar year?
Next calendar year, when you're meaning Q4 of next year and Q1 of the year after, the Q4 current and the Q1 of the next year. My take on that is cement will start reviving by Q1 of next year, because I have seen the consumption pattern increasing. The northern sector cement companies are already reporting 80-85% capacity utilization. Southern side is certainly a little lagging behind, but they can also catch up. Construction is restarted across the country. I can see that also in the movement of tar steel which goes into construction. So cement companies would naturally come for next level of expansion program by Q1 of next year. On the power sector, I don't expect any substantial improvement to happen on the next maybe 12 to 18 month period. You will find some isolated orders getting concluded in the next maybe 2 or 3 quarters. There are 3 or 4 inquiries in the annual for supercritical. But beyond that, I don't see anything happening in the next maybe 12 to 18 month period. Steel can revive, because once the construction catches up and the government is finalizing multiple contracts on the road side, so you should be seeing steel sector partially taking a positive turn. I've seen the balance sheet of some of the Indian steel companies for the last quarter. Many of them were in a much better position than what we anticipated. So I'm sure they should also look at expansion. These are the two sectors which I'm expecting to be turning around. The PSUs, the oil sector, the government has already indicated that they better invest some money on the balance sheet available. Otherwise, they'll have to declare it as special dividend and the government will take it away. I'm seeing a movement in terms of request for quotations and DPRs getting prepared for refinery expansions in the country. But normally, refinery expansion would take not less than maybe a 9 to 12 months for it to be coming to a level of finalizing contracts for people like us. But I expect a movement in that area too.
Mr. Unnikrishnan, what about your guidance for FY13 and the first quarter of the next calendar year as well? Because you revised your margin guidance downwards considering high input costs.
I haven't changing any guidance. Normally, we don't have a habit of giving a guidance, but you guys prod me to give some numbers. So what I have told is margins are under pressure. There is no substantial improvement in the margin availability for all of us. When you finalize the order, you are normally finalizing orders at median level margins, and you strive to make it to a better margin to almost closer to double digit as you execute the contract. And I still retain that argument. We should be able to come closer to a double digit margin even with the difficult circumstances prevailing in the market.